You and I are only going to look at one extremely important chart together today, and it has nothing to do with numbers. Let's take a short emotional journey together, you and I. Settle in and watch this video until the end because you're going to learn something new about yourself. It has to do with your investing emotions and feelings, and even how to process what your family and friends tell you throughout your entire lifespan. Yeah, I guess I'm getting touchy-feely here. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and 20-year real estate investor. I also host the weekly Get Rich Education podcast, which is different from this show. That way you can listen to me on the go on Apple Podcasts, Spotify, or the Get Rich Education mobile app. For a long time, I've said that it's difficult to get any long-term return from stocks and mutual funds after you account for what so few know to. From your, say, 10% stock or mutual fund return, deduct out inflation, emotion, taxes, fees, and volatility, and that's why I don't invest in those vehicles. So let's look at that emotional part of your investor journey. Outside of dividends, stocks are largely a game of buy low and sell high. Buy low and sell high? Well, that sounds easy. But then wait, why is it harder to do than it sounds? That is called the cycle of investor emotions. All right, well, it starts right here with optimism. All right, because you hear about 10% stock returns. Let's say that you are not fully invested in the stock market. You're mostly on the sidelines, but some friends are in and they're achieving some small gains. Well, then comes excitement. The market is up now some more, and hey, what's in motion tends to stay in motion. More friends are telling you how much money they're making, and simultaneously you read and you see articles and you're sort of bathed in this media bath of everyone achieving high returns, and soon enough you are experiencing a full-blown case of FOMO, a fear of missing out. Well, the next stage is the thrill that you begin to feel. So you jump into the stock market fully rationalizing with something where you tell yourself like, well, hey, I'm a momentum investor. That sounds pretty good, I guess. And now that you're in, it actually feels fantastic to you for a short time. And you figure that some days you're making more from stocks than your own job, and this winning activates dopamine. Yeah, dopamine. It is a brain chemical. It's known as a feel-good hormone, and it gives you a sense of pleasure. And it also gives you the motivation to do something when you're feeling the pleasure. So then you go ahead and add more shares. You buy more at an elevated price until you are fully invested. You're completely in, and now it feels like everyone is making money, even your Uber driver. Well, the next stage is euphoria, the peak. And as you can see, this is the point of maximum financial risk. Okay, it's time to remember the simplicity of buy low and sell high. Well, then what does a savvy stock investor do? Well, they should be selling right now. Now be selling? Leaving the party at its crescendo? Stopping the dopamine flow? Yes, exactly. And see, that's why it's so difficult. All right, well, obviously what happens after the stock market peak? Well, being overbought with bloated price to earnings ratios, the market soon drops 10% from its recent high. This is what's known as a correction, a drop of 10% or more. All right, you're mostly okay, but now you feel a little anxiety and your dopamine flow is certainly stifled. And next, you tell yourself something like, well, I shouldn't be worried because I'm a long-term investor. But now the market's down 15%. Now you're experiencing denial and fear. Now you're checking the Robinhood app almost hourly to see if it's going to recover. And then next comes desperation and panic. Stocks are down 20%. That's the very definition of a bear market, down 20% or more. And you'll find yourself devoting more mind share to this each day than what's healthy. Then there is capitulation, down 30%. You have just had enough. You finally surrender to a fear of further loss. You're getting so sick of months of losing that you finally do it and cash out your stocks into a safe money market fund. Now you are out, and you rationalize and you justify doing this because you tell yourself, you know what, at least when I wake up tomorrow, I'll know that I haven't lost money again, and that gives me certainty. The next stage in the cycle of investor emotions is despondency. You realize that what you've done is the polar opposite of successful investing. It is complete. Now you've bought high and then you sold low. Well, next, stocks completely bottom out, but on our chart, notice that this is actually the point of maximum financial opportunity. So instead, you should be buying, but you can't because you're experiencing the next investor stage, depression. You're so full of contempt for the situation that the idea of actually buying at bargain basement levels again is simply inconceivable. You've been burnt badly. And then there's hope and relief. You know, the market has actually begun ticking up a bit after its latest crash, and it should soon be clear that share prices are fairly valued again. But you know what? You don't buy the recovery story. You wait until enough price growth occurs that the confidence and the optimum stage is felt again before you'll even consider getting back in and buying, and the entire pattern repeats. That is the cycle of investor emotions. And there's an average of 3.5 years between each bear market. That's one of the 5 drags of stocks: inflation, emotion, taxes, fees, and volatility. We've discussed the emotion here. And of course, we've been kind to call all this investing. It's more like speculating. But here's the real problem. Most investors think they're better than average stock pickers, so they keep playing this game, and this effect is called illusory superiority. It's like how at least 70% of people think that they're better than average drivers, despite the statistical impossibility there. Even professional money managers fall prey to this. Fewer than 10% of active US stock funds manage to beat their benchmark. It was the renowned British economist and value investor Benjamin Graham that once said, "The investor's chief problem, even his worst enemy, is likely to be himself." As real estate investors, we largely sidestep the cycle of investor emotions for 2 main reasons. Returns are more stable, and appreciation is one of only 5 ways that you're paid. I'll be back with another video here soon. In the meantime, catch me next Monday on the weekly Get Rich Education podcast, which is different from this show. That's my audio-only program where you can build your real estate wealth by listening to me on the go, again, through Apple Podcasts, Spotify, or the Get Rich Education mobile app. I'm Keith Weinhold. I'll see you in the next video.